What if we told you that a single government decision, one sentence from China's aviation regulator, wiped out billions of dollars in market value, put tens of thousands of American jobs on the line, and threatened to unravel decades of global cooperation in the skies? Welcome to the new front line of the US-China trade war. This isn't about soybeans, semiconductors, or steel tariffs anymore. It's about planes. Boeing planes. And if you're thinking this is just another blip in global trade disputes, think again, because this one could crash land the entire civil aviation sector. The Civil Aviation Administration of China recently issued a bombshell directive: halt all deliveries of Boeing aircraft. That one order sent Boeing's stock into a tailspin, erasing up to 10% of its market value in mere days. But this isn't just a market story. It's a geopolitical earthquake with economic aftershocks that will ripple across continents, industries, and generations. Behind the headlines lies a dramatic tale of billion-dollar deals, diplomatic chess moves, and a company caught in the middle of the most high-stakes standoff of our time. To grasp the true magnitude of what's at stake, let's rewind the tape and look at the numbers that define Boeing's global presence. At the end of last year, Boeing had around 4,500 jets in its global order book. Out of those, more than 1,200 were linked to Chinese airlines or leasing companies. That's roughly 26 to 28% of all Boeing orders, more than a quarter of its business hanging in the balance with a single country. Each wide-body jet carries an average list price of about $300 million. For narrow-body jets like the 737 MAX, it's around $110 million. Even after negotiations and discounts, Boeing's contracts with China alone translate into $10 to $12 billion in annual revenue. And when you add in long-term maintenance agreements, spare parts, and services, the number gets even bigger. Now imagine slicing that chunk of revenue out of the picture in an instant. That's exactly what China's order to halt deliveries has done. And that's why Boeing's shareholders panicked. Some analysts believe this one move could eventually slash $40 to $50 billion off Boeing's market cap if tensions persist. The decline of nearly 10% in share price after the announcement wasn't just about current orders, it was about future prospects. Because when a company is seen as politically radioactive in a key market like China, it's not just one quarter of revenue at risk, it's a multi-decade relationship with the world's second-largest economy. And this isn't just about Boeing. This affects the entire US economy. Civil aviation is one of America's biggest export categories. Each year, the US exports roughly $130 to $140 billion worth of aviation equipment. Boeing makes up a substantial portion of that. China accounts for 15 to 18% of these exports. Losing that market could mean a drop of $20 billion or more in aviation-related exports alone. And we haven't even gotten to the supply chain yet. Boeing's manufacturing network spans almost every state in America. From avionics in Florida to engines in Ohio, to fuselage parts in Kansas, and landing gear in California, thousands of suppliers are involved. Some estimates suggest that if China's freeze continues, anywhere from 5,000 to 10,000 jobs in the US aviation supply chain could be lost by the end of 2025. The blow wouldn't just hit Boeing's engineers, it would impact small manufacturers, family-owned businesses, and entire local economies tied to aviation. But while Boeing and the US economy brace for impact, what about China? On paper, replacing Boeing isn't a plug-and-play option. Chinese airlines still rely heavily on the 737 MAX, 777, and 787 models for long-haul routes. Switching to Airbus, or accelerating the production of domestically manufactured jets like the Comac C919 and CR929 requires massive investments in pilot training, maintenance infrastructure, and logistics. We are talking millions of dollars and years of transition. So why would Beijing risk such chaos? Because in the logic of a trade war, suffering is seen as strategic leverage. The Chinese government may be betting that while they'll endure short-term pain, the long-term damage to Boeing, and by extension, to the US economy, will be far greater. This isn't just tit-for-tat tariff politics anymore. This is a long game, a war of attrition. One side believes it can outlast the other. And Boeing is collateral damage. Zooming out, this move fits into a broader pattern. The US has ramped up tariffs on Chinese tech and industrial imports, some exceeding 100%. China, in turn, has targeted agriculture, energy, and now, civil aviation. This isn't just economic warfare. It's geopolitical signaling. By targeting Boeing, Beijing is sending a message: no sector is off limits, and even America's crown jewel exporters aren't safe. Back in 2024, combined orders from China to both Boeing and Airbus totaled around $14.5 billion. If China decides to funnel more of that money to Airbus, or even to boost COMAC's role, Boeing's annual revenue from China could plunge from $10 to $12 billion to just $5 to $6 billion. A long-term shift of that kind could lead to a permanent erosion of market share. And investors know it. That's why the mere rumor that Airbus might ink a major 150-plane deal with China sent tremors through the financial world. Boeing executives have called this their worst-case scenario, and they are not exaggerating. The stakes are even higher when you consider the long-term prospects. Chinese airlines plan to purchase over 500 new aircraft in the next decade. Historically, Boeing had a major share of those deals. Each delivery represents not just $100 to $300 million in revenue, but up to $500 million when maintenance and support contracts are factored in. Losing out on those future deals could mean missing out on more than $150 billion over the next 10 years. And once lost, those deals are nearly impossible to win back. Despite these risks, the political will in Washington remains firmly entrenched. The Trump administration has doubled down, accusing China of backing out of the Boeing deals unfairly and calling out Beijing for currency manipulation and trade distortion. President Trump's remarks suggest that Washington sees Boeing's struggles not as a reason to backtrack, but as proof that the administration's hardline stance is working. It's a calculated gamble. But it's one where Boeing pays the price today for potential political gains tomorrow. Inside Boeing, the mood is tense. Lobbyists are sounding alarms to lawmakers, warning that prolonged trade hostility could shut them out of the Chinese market for decades. Executives are saying privately that the fallout from this trade war could linger for 30 years or more. And while some in Congress are urging flexibility, hoping to salvage Boeing's access to foreign markets, the dominant view in the administration is to stay the course, no compromise, no retreat. Meanwhile, Airbus is quietly watching from the sidelines. Officially, they are saying they don't want to profit from trade wars. But if Beijing comes calling with fresh orders, Airbus won't say no. Their share price has ticked up slightly, hinting that investors are betting on a windfall if Boeing continues to lose ground in China. If a formal Airbus-China deal is announced soon, Boeing could suffer another blow, one from which it might not recover easily. Beyond the commercial losses, the geopolitical symbolism of this showdown is impossible to ignore. Boeing is more than just a company. It's a symbol of American industrial power, innovation, and global reach. For China to target it so directly is a bold move. And if Boeing can be used as leverage today, who's to say other American giants won't be targeted tomorrow? From semiconductors to pharmaceuticals, the list of potential retaliatory sectors is long, and the trade war could escalate rapidly. Already, whispers are growing that other industries could be next. If Beijing retaliates further against agricultural imports, chemical products, or even key semiconductor components, the economic war will widen. And if Washington counters with more sanctions, more bans, and more tariffs, the world could be staring down the barrel of a full-blown trade crisis that ripples far beyond aviation. For now, Boeing is the canary in the coal mine. Its troubles reveal just how intertwined and how fragile the global economy has become. A single diplomatic freeze can jeopardize $150 billion in potential deals, threaten tens of thousands of jobs, and shake the stock markets across continents. The worst part? There's no clear end in sight. Could back-channel diplomacy save the day? Maybe. But unless both Beijing and Washington reach a point where the economic pain becomes unbearable, compromise seems unlikely. In the meantime, Boeing remains in limbo, caught between political agendas and global supply chains, with everything to lose. So the next time you see a jetliner soaring overhead, remember, there's more riding on it than just passengers and cargo. There are billions in trade, decades of diplomacy, and the fate of an entire sector hanging in the balance. Will Boeing bounce back? Or is this the beginning of a long, painful descent? One thing's for sure, the skies just got a lot more turbulent.